It started with one sentence, and it nearly crashed the dollar. Scott Bessent stood before reporters, vowing a decisive U.S. response to China's export cuts. Within hours, Beijing's markets roared, Wall Street panicked, and rare earth futures exploded 12% overnight. Then, silence. By sunset, the White House deleted the line, rewriting it as "we'll review all options." One phrase erased, billions wiped off markets. What did Bessent see that made him fold in less than a day? According to Bloomberg data released in late September 2025, China's exports of rare earth oxides to the U.S. dropped by nearly 37% in April before partially recovering in July. But the short-lived disruption was enough to expose how fragile the U.S. supply base remains. Since the 1990s, when processing shifted to Inner Mongolia, China has built control over more than 80% of the world's refined rare earth supply. The U.S. reopened its sole major site in Mountain Pass, California, but Reuters reported in August that over 90% of its concentrate still gets shipped to China for processing. In other words, even America's domestic supply line ends in Chinese factories. Bessent knew this. He'd been warning since his confirmation hearings that the U.S. economy could be weaponized against itself if it failed to build resilience. Yet his own Treasury strategy depends on cheap imports to restrain inflation. In a briefing to Congress, he accused Beijing of industrial coercion, pointing to export monitoring rules announced by China's Ministry of Commerce on July 1st. The Chinese statement said the controls were to safeguard national security and interests. That was nearly identical language to the export curbs the U.S. imposed on semiconductors the year before. The symmetry was difficult to ignore. When the Financial Times pressed Bessent about the parallels, he deflected, saying, "We're operating from a rules-based framework." But the markets weren't listening to words, they were watching actions. In the 3 days after his comments, the 10-year Treasury yield climbed 26 basis points. That wasn't Beijing dumping bonds, at least not yet, but investors pricing in the risk that China might. According to U.S. Treasury data for August, China reduced its holdings of U.S. debt by another $25.4 billion, bringing its total to $744 billion, the lowest since 2009. For Beijing, that's not a sell-off, it's a message. Meanwhile, China's own export machine was running hotter than expected. Reuters figures from the General Administration of Customs showed an 8.3% year-on-year rise in total exports for September, the fastest pace in 6 months, reaching roughly $330 billion. The destination mix told the real story: shipments to the U.S. fell 27%, but exports to ASEAN, Africa, and Latin America surged double digits. The pattern signaled what economists at Nomura described as a strategic reorientation of supply chains away from tariff exposure. In short, Beijing wasn't retreating. It was rerouting. Bessent's reaction was half diplomacy, half theater. At a Seoul press conference, he called China's export restrictions provocative, yet insisted the U.S. sought constructive dialogue. The juxtaposition was striking, one sentence condemning, the next conciliatory. The Wall Street Journal described it as a rhetorical U-turn performed in real time. That's because Washington's options were narrowing. If the U.S. pushed ahead with Trump's proposed 100% tariffs on Chinese goods, announced but never enacted, it risked triggering a rare earth embargo that could shut down defense manufacturing lines within months. If it backed down, it looked weak. The Treasury chose ambiguity. Behind the scenes, the data told a deeper story of retreat. IMF trade balance estimates for the third quarter of 2025 showed the U.S. goods deficit widening to $101 billion, while China's surplus hit a 10-month high. That gap wasn't just steel and electronics, it was dominance in the inputs powering the energy transition. China exported nearly 70% of global lithium-ion battery cells, 80% of solar wafers, and 60% of processed graphite. Each one sits inside the supply chain of every Made in America initiative. The U.S. couldn't sanction those materials without sabotaging its own reindustrialization drive. Let's pause for a moment, because the crisis Bessent is facing isn't ideological, it's arithmetic. The more Washington raises tariffs, the higher domestic costs climb, which, forces the Fed to keep interest rates elevated. But those same rates strengthen the dollar, making U.S. exports even less competitive and, honestly, deepening dependence on imports. China, in contrast, can subsidize losses indefinitely through state banks and still maintain positive export momentum. The contradiction here is structural, not political. Nowhere is that clearer than in semiconductor policy. The Biden-era CHIPS Act had earmarked $39 billion in subsidies, but as of 2025, only 30% had been dispersed. Bloomberg reported that Chinese firms filled much of the shortfall abroad, offering cheap fabrication partnerships in Malaysia, Thailand, and Mexico. Bessent's attempt to isolate China ended up globalizing it instead. Washington's allies became alternative routes for Chinese supply, not replacements. A senior official from Japan's MET told the Nikkei in September, "We are diversifying through China, not away from it." Even the dollar, once the anchor of U.S. leverage, is showing stress. SWIFT data published in August showed the renminbi rising to 5.8% of global payments, its highest share on record, while the dollar fell below 47%, the lowest since 2012. Those are still distant figures, but the direction really matters. As the Financial Times noted, each percentage point the yuan gains is another constraint on U.S. financial diplomacy. Bessent's rhetoric about monetary containment sounds strong in Washington. In Singapore, it sounds nostalgic. Meanwhile, Beijing's restraint is its most potent weapon. Despite all the warnings, China hasn't formally cut off rare earths or imposed new quotas. It hasn't needed to. The fear of potential action has already reshaped global pricing. The World Bank's September commodity outlook shows rare earth prices up 18% since April, despite stable supply. That's what economists call anticipatory inflation. Markets raising costs on rumors alone, and every uptick erodes the competitiveness of U.S. manufacturers faster than any tariff could compensate. So what exactly is Bessent's endgame? Officially, it's about supply chain security. Unofficially, it's political insurance. Reuters reported that Trump had grown frustrated with the lack of visible wins from the tariff program, demanding a headline result before year-end. Bessent's pushback against China was meant to signal toughness without escalation, a balancing act that no Treasury Secretary has pulled off since James Baker in the 1980s. The problem is that the global economy no longer moves by press release. It moves by production. Production, right now, favors China. Industrial output there rose 6.2% in September, according to the National Bureau of Statistics, compared with 1.8% in the U.S. Manufacturing PMI in China ticked back above 50, signaling expansion, while the U.S. ISM Manufacturing Index stayed in contraction for the 15th straight month. Those numbers don't lie. They reveal that tariffs might alter trade flows, but they don't change where the real economy is operating efficiently. Bessent's team is now split. One camp wants to double down, extend export controls to Chinese logistics and digital platforms. The other urges negotiation, fearing contagion through capital markets. The Financial Times quoted one senior Treasury official anonymously saying, "We can't isolate China without isolating ourselves." That line may not appear in public transcripts, but the bond markets have already priced it in. Credit default swap spreads for major U.S. corporates rose 9% in late September, the steepest weekly climb since 2023's regional bank scare. Fear, once abstract, is becoming quantifiable. At the same time, China's inbound investment is rebounding, not collapsing. Official data shows foreign direct investment rising 6.4% year-on-year in August, led by German and ASEAN manufacturers, repositioning production for export to the global south. The Wall Street Journal noted that China's export strategy is shifting from volume to influence. That influence now extends to pricing energy contracts in Yuan, offering credit lines in African infrastructure projects, and settling commodities in Shanghai rather than London. The trade war, meant to isolate China, is accelerating its integration elsewhere, and yet Bessent keeps talking tough. On CNBC last week, he insisted, "We're not backing down from defending American industry." But defending isn't the same as winning. The logic of escalation collapses when your rival controls the cost base of your own economy. That's why, after all the bluster, Bessent quietly delayed the 100% tariff implementation. Officially, it's under review. In practice, it's shelved. Bloomberg analysts described it as policy paralysis masquerading as prudence. The immediate relief on Wall Street was visible. The S&P 500 surged 3% in a single session after his announcement. But the rally's foundation was paradoxical. Traders weren't celebrating victory. They were cheering avoidance of disaster. Even Goldman Sachs' head of global research, Jan Hatzius, told clients, "The U.S.-China trade dynamic now operates under a doctrine of mutual constraint." Translation: both sides are too entangled to break apart, but too distrustful to rebuild confidence. If there's a quiet victor in all this, it's Beijing's timing. Just as Bessent's rhetoric peaked, China published new data showing retail sales growth of 4.9% and rising auto exports, especially electric vehicles, to South America and Eastern Europe. Those markets are now absorbing the output that once headed for the United States. Tesla's Shanghai plant, according to Reuters, shipped 64% of its production abroad last quarter, up from 47% a year ago. The redirection isn't defiance, it's diversification. And, diversification is a shield against leverage. Let's consider the psychology for a moment. Washington treats China's moves as aggression. Beijing sees them as adaptation. Both views contain partial truths, but only one is aligning with measurable outcomes. IMF projections for 2026 put China's share of global manufacturing at 32%, a record high, while the United States falls below 15% for the first time. The divergence isn't caused by policy missteps alone, it's baked into the structure of globalization. You just can't tariff your way out of a cost imbalance without changing how your economy produces. And that's the part Bessent avoids saying out loud. Because honestly, admitting it would mean acknowledging that the United States has fewer levers left. Fiscal expansion is constrained by $38 trillion in debt. Monetary policy is trapped between inflation management and political pressure. Industrial policy is reactive, not anticipatory. Every new initiative, whether chips, batteries, or defense materials, still traces a supply chain line that runs through Chinese ports. The ultimate irony is that the rare earths China controls aren't even rare. They're actually abundant, but the refining process is, well, messy, toxic, and honestly unprofitable without scale. Beijing accepted those costs decades ago, while Washington chose to outsource them. Now, the same environmental standards that once seemed virtuous have become strategic liabilities. The market isn't punishing China's dominance, it's rewarding its tolerance for industrial risk. By early October, when Treasury aides briefed reporters again, the language had shifted once more. Bessent no longer spoke of decisive responses, but of cooperative frameworks. Behind that diplomatic phrasing lies the recognition that confrontation has limits when economic interdependence is the foundation of both sides' power. The United States can threaten tariffs. China can adjust trade routes. Each gesture pretty much cancels the other's leverage. What remains is performance, and markets don't trade on performance forever. So the real question isn't whether Bessent chickened out, it's whether he ever had a credible option to begin with. Because when one side controls the materials, the processing, and increasingly the currency of exchange, confrontation becomes a negotiation over tempo, not outcome. Beijing seems pretty comfortable with that tempo. Washington, less so. And as the data keeps coming in, China exporting more, importing more, accumulating strategic partnerships while quietly divesting treasuries. The story shifts from geopolitical rivalry to, well, financial inevitability. The trade war that began as punishment has turned into proof of imbalance. So what happens when the side meant to dictate terms is forced to follow them instead? We're glad you're enjoying this video. Please like and subscribe. And hey, check out another video that is now on your screen.